Okay, good afternoon, everybody, and thank you for joining this InvestEngine webinar on why investing should be part of your business planning. My name is Andy Prosser. I'm the head of investments at InvestEngine, and I'm joined today by Chris Downing, who's a director for accounts and bookkeeping at Sage. Thanks for joining us, Chris.
Thank you very much for inviting me.
So in terms of the plan for the webinar, Chris and I are going to be going through a few slides on business accounts, and that should take us about 35 minutes-ish. Which will leave us 5 to 10 minutes at the end for a bit of Q&A. So aiming to be wrapping up at about 5:45. Now, if you do want to ask questions as we're going through the presentation, you should be able to click on the little Q&A button in the bottom of the screen. The questions are not going to be broadcast to the whole webinar chat. They'll just come straight to us. So don't worry if you think you've got a stupid question. That's totally fine. Feel free to ask away and we'll answer as many as we can at the end. So let's get into it then. Next slide, please. Yes, but just before we get into it, here is the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK residents only, and that none of this is financial or tax advice. And with that, let's go. Okay, Chris. So I think that given this is a webinar about making more from your money in a business account, I think probably the main question that people will be asking is how can I make my cash work harder for me? So the plan is to kind of talk about two ways of doing that. The first one is how to earn higher rates than you'd be able to get from your bank for any excess cash that your business might have. And then the second is how to earn higher long-term returns by investing through your company. So I suggest we get cracking with point number one on that, which is beating the bank. So if we can skip ahead, please. Thank you. And here we go. So I think to answer the question, spoiler alert, to answer the question about how you're able to get better rates in your bank, the answer is what we call a money market fund. So Chris, maybe I can explain what a money market fund is, and then you can explain why you might want to use one versus a current account, for example. So as a kind of brief introduction for those who are on the webinar and haven't heard of a money market fund before, it's essentially the lowest risk form of investment that you can have. They track what's called the SONIA rate, SONIA, which stands for Sterling Overnight Interest Average. It's also called the overnight rate, and that's the blue line on the chart there. And it's called the overnight rate because that's the rate at which banks lend money to each other overnight. And it's really, really closely correlated with the Bank of England base rate. And because the base rate has been increasing so much over the last couple of years, that means the overnight rate's been increasing, which means that these money market funds, which track the overnight rate, are offering really high returns. And they're able to do that by investing in very, very short-term securities. So it's things like government bonds that are very, very close to maturing, high-quality corporate bonds, time deposits, commercial paper, and things like that. So the key is that they're very, very, very low risk. And I think it's kind of obvious from the slide there, but Chris, what do you think the main advantages of the money market funds are over, say, a bank account?
Everyone loves a pretty picture, don't they? And I think that graph demonstrates it really, really well. I think when it comes down to a better return or a higher return, and as you can see, it's quite significantly better than what the banks traditionally do, but also it's probably the flexibility and in the ease of use, because traditionally, let's say if you're depositing money, if you do have a deposit bank account, it's something that you need to open. And if you've just got a normal current account with your bank in terms of working with business day to day, the interest rates tend to be really low. So therefore the ability to transfer money easily, have visibility of the rates available, plus also be able to track and withdraw that money just in case you need to pay the VAT or the payroll, the wages, or even your corporation tax liability. That flexibility is key, because usually when you're looking to try and get higher rates return of the bank, your cash tends to be locked up when actually you want easy access just to when you need it.
Yeah, I think that's a really key point, actually, is the fact that these are liquid. So you can sell the fund and withdraw the cash at any time. There's no lock-in periods. It's not like a fixed term deposit where you have to keep your cash locked up for 3, 6, 12 months, for example. All you need to do, these are ETFs. All you need to do is sell that ETF, wait for it to settle, which takes a couple of days, and then you can withdraw that cash. So yeah, I think that is the key, is that it has a much higher rate of interest than your bank account and is also just as liquid. That rate there, 2.69, that's taken from the Bank of England. But anecdotally, I've been speaking to quite a few business owners recently, and I think a lot of banks have rates that are worse than that.
I think that's the norm, isn't it, really? And
yeah.
I suppose how many people on this call do actually look at what interest rates do they have when they're in credit, and they'll probably be very surprised and probably very frustrated that it's probably closer to one, if one just above it, if they're lucky.
So in terms of how to get access to these things, if you can skip to the next slide, please. Here are the returns over the last, oh, no, one before that. Yeah, there we go, that's the one. So this is just kind of gives you an idea of how to access the money market fund on the investment platform. This is a chart of the returns over the last 10 years or so since the ETF was launched in 2012 of an ETF called the Xtrackers GBP Overnight Rate Swap ETF, which is a money market fund that tracks this overnight rate. You can see it didn't really do much when rates were low, which kind of makes sense. But now that rates have increased dramatically, the ETF is now yielding over 5%. Now, I do need to, with my risk/compliance hat on, mention that there is a risk of incurring a small loss when investing in a money market fund, and that's because you're investing in short-term bonds rather than a current account. Now, having said that, the potential losses are far, far smaller than with traditional investments. And if we use this ETF as an example, I was crunching the numbers before we came on the webinar. The biggest loss since the ETF launched in 2012 has been minus 0.16%. And that was at the end of 2021 when inflation started to take off and interest rate expectations went through the roof. So a terrible time for bonds. But the drawdown was so small, the loss was so small that you can't even see it on the chart. So I think for all practical purposes, it can be used. Money market funds can be used in the same way as a bank account. I don't want to kind of preempt. Actually, I think it's the very next slide in terms of use cases. But we've got a bit on tax coming up later. And another advantage, big advantage of using money market fund, aside from the higher rates and liquidity that we talked about, is that you don't have to withdraw the cash from your business, which means that you don't have to pay tax on the dividends that you are withdrawing. So yeah, we do have a slide on tax coming up later on, but it's worth mentioning here because I think it is another good benefit of investing in a money market fund because you don't have to take the cash out. Yes, thanks, Rich. So we're on the use cases. This slide shows how some of our business account holders on the Invest Engine platform are using money market funds. So these are examples from real clients. So Chris, I don't know, maybe I can talk through these, and then I think it'd probably be interesting to hear if there are any other use cases you've come across, or maybe some examples of how Sage clients might be using their money market funds.
So I think from a basic level, it's a case of if you're on top of your numbers and top of your finances and bookkeeping, you should have a reasonably good idea of what your VAT liability is going to be. Yes, some businesses are seasonal, but if you know what your VAT liabilities are going to be, you should be saving for it. And then in terms of, let's say, your corporation tax bill, that's something which we hate to pay, and that's payable 9 months after your year end. So if you imagine most businesses will probably have a March year end. They've just finished trading for, let's say, March 2024. Do you know what your tax liability is, your corporation tax liability? Have you saved for it? And if you have, what are you doing with that cash? Because potentially you don't have to pay that over to the tax man until the end of December this year, which means that actually, what are you going to be doing with it? And then with VAT, it's something that's paid quarterly. So you've got these really quite lumpy tax liabilities, which are payable, you know when they are payable, and therefore what return are you getting from it? You're probably getting minimal return currently sat in your current account, business current account, therefore making it work better is key. But also it's a case of, like any business, if you understand your financial position, who owes you money, and if you know that you can get a better return on cash, it may sort of make you think, well, how are people paying me? You think about all your customers. You put terms on your customers' details in terms of should they pay you within 14 days or 30 days. When is the last time you look at your age sales ledger and you've got people owe you money from 60 to 90 days ago? Yes, you would like that cash within your bank account, but actually that cash could work even harder if you're actually putting it into investment engine funds to actually get the better return. But also it's the fact that if you understand who you owe money to, you've got stock and consignment, and you've got suppliers which give you more favorable terms of 60 days, well, manage when you need to pay them, keep the cash to one side and get a better return while you actually pay those suppliers off. So it's all about really understanding your finances and the many opportunities.
I think that bit on tax is really interesting as well. I think a nice way to think about it, at least this is how I would think about it if I ran a business, is it kind of reduces the tax that you have to pay, because the interest that you earn from the money market fund, you can use that to kind of mentally account and say, right, that's offsetting the tax that I've got to pay, and everyone loves paying less tax, right?
Yes.
So I think that's a really powerful way to, in your own mind at least, even though all cash is fungible,
And
pay less tax.
And also, you think most people say, I didn't expect that tax bill. But if you're
Mm,
trading a business, you had a tax bill of 15, 20, 40,000 pounds last year, assuming that your trading year is similar, you're going to get the same sort of tax bill. So if you've got a 40,000 pound tax bill, usually, why aren't you putting £3,500 per month into a deposit account? Because you
mm,
know you've got to pay that off. And therefore, I think that sort of approach to business in terms of when you're at the end of the month, who do you pay? Obviously, pay yourself first because that's
mm,
your remuneration, but you need to be thinking about who else you're paying. You need to be paying the tax man. That's going to be either VAT or corporation tax, and therefore, can you put that to one side and then think about how you pay your suppliers? But that's good old sort of fashioned, say, cash saving, having a war chest, but actually making sure that war chest is working a bit harder for you.
mm. Yeah, so I think the main idea here is that any idle cash could be put to work and earn a much better return than if it was just left at the bank. And I think the key is that these money market funds really are for short-term goals. We've talked about tax liabilities, paying suppliers. You can even put payroll in money market funds. So this is for cash that needs to be used in the next 6, 12, and even 2 to 3 years. Short-term goals, that's the key. And this brings us on to the second main way that clients have been using our business accounts, and that's for longer term investing. So if we can skip to the next slide, please. Yeah, this is investing through your company. So the key question here, I think, for business owners is why would you want to invest through your company? And that splits into two questions. The first question is why would you want to invest full stop? And second is why would you want to do it through your company? So the kind of two halves to that question. So if we just take the first half first, is the kind of more general, why would you want to invest? Really, there are two reasons. The first one is inflation, beating inflation. And the kind of idea behind inflation is that over time, our cash becomes less valuable because the prices of stuff keeps going up over time. I actually used to have quite a hard time explaining what inflation was to people because the rate of inflation was so low that it wasn't really noticeable for most people. But now, over the last couple of years, I think we've all seen the effects of inflation having a pretty direct impact on us. So I think it's a bit more of an understood idea now. That's just my kind of personal opinion. Am I right in thinking that, Chris? Do you think we're all pretty familiar with the kind of pernicious effects of inflation?
Yeah, whenever there's change, people suddenly increase their education and awareness. And we've
Yeah.
seen this all over for the last 12, 18 months. Inflation has been the theme of the day. What is it going to be? Is it going to be double digit when it's going to reduce? Yes, it's been reducing, but also people have a better understanding in terms of where it comes from, how it's calculated, and the impact it has, let's say, on the supply chain and people's wages, but also more
Mm.
importantly, the effect it has on cash. So yeah, I think people are having a great awareness.
Yeah, and just to hammer that point home, the very next slide shows the value of £100 over time. If we can skip to the next slide, yeah. So this is just showing that 100 quid of cash in 1999 gradually becomes worth less and less because the price of goods and services goes up every year. So if you keep the £100 in cash, then today, instead of being able to buy £100 worth of stuff like you'd have been able to in 1999, you now only be able to buy the equivalent of £55 worth of goods and services because prices have gone up. And if you look back over the long term, inflation's averaged about 2.5% since 1999. So in effect, your cash is reducing in value by about 2.5% every year. It's obviously been much worse than that recently. We had inflation hitting just over 11%, I think it was 11.1% at the end of 2022. And although inflation is now starting to come down, we saw the latest UK inflation figures coming out the other day. It doesn't mean that prices are falling, even though the rate of inflation is going down. It means prices are still going up, but just at a slower rate. So you need some way to avoid your cash just losing value over time. And that's really where investing comes in. So the next slide does a good job of showing simply that over time, stocks beat inflation by quite a handy margin. And the longer that you hold stocks for, the more likely you are to beat inflation by. So to beat inflation for the long run, the best way to do that is through investing in the stock market. And that answers kind of the first part of the question on the inflation bit about why you should be investing. The second reason I think that people should be investing full stop is because we all want to retire at some point. And I think this is the more kind of tangible, realistic way that people are investing. And because stocks have such a high return, as you can see on the graph there, much higher than cash or bonds, they're a really good way to save for retirement. And stocks benefit really well from this idea of compound interest, that is interest on interest. So the longer you hold your stock market investments for, the higher your returns are going to be. So if we skip to the next slide, this kind of puts this is quite a nice slide. I like this one because I get asked this quite a lot. How much can I expect to make from investing in the stock market? So I put this slide in here, not just to give an idea about the long-term expected returns, which are the kind of pink circles, but about the risks as well, because I think that's a really important point to think about. And the chart here shows that it shows the long-term annual returns for a portfolio of 100% bonds on the left-hand side, 100% stocks on the right-hand side, and then combinations of the two in between. I think it shows a few things. Firstly, the kind of main thing that jumps off the page is that stocks do have higher returns than bonds over the long run. So if you're wanting to invest for a goal, say retirement, that's quite a long way away, then you should be choosing to put more into stocks. They have a higher return, but they are prone to large drops. So the idea is that if you're saving something that's far away, you have the time to recover from those losses, and so you can reap the rewards from those higher long-term returns. But bonds on the left-hand side, they're less volatile. When they fall by less than stocks, so they're safer in the short term. So if you're investing for a retirement that's closer, say in a few years' time, then more of your portfolio should be in bonds because you don't want to risk your portfolio falling by a large amount. And I think one of the most difficult things in investing, and it's actually, I think it's a bit underappreciated, is figuring out where on that spectrum you should be sitting. Should you be 100% stocks? Should you be 100% bonds? Should you be somewhere in between? And it's obviously different from person to person. Some people should be taking more risk and they're happy to take that risk, but some people either don't need to take that much risk because their goal is, the next few years, or they're not comfortable with the large falls that can happen in stocks. You can see there that UK stocks fell over 40%. That was in the dot-com crash, and global stocks fell by even more than that. And not everybody can handle watching their portfolio literally halve in value. So in which case they shouldn't have all of their portfolio in stocks, right? So just as a kind of PSA, anybody on this webinar who's not sure about how to assess their own risk profile, we offer a risk profiling tool on our website. It is part of the sign-up process for the managed portfolios, but you don't have to open a managed account to access the tool. It's basically just a short series of questions, about 10-ish questions, which ask about your willingness and your ability to take risk. And then at the end of the questionnaire, it'll give you an idea of roughly what your asset allocation should look like. Now, obviously, we're managing these portfolios. We think they're a really good idea for most clients because it involves us building this fully diversified portfolio to match your risk profile. And then on an ongoing basis, we'll actively monitor the risk levels to make sure it stays in line with that desired level of risk. But even if you're just kind of curious about how much risk you should be taking, then I think it's a really good starting point. I do recommend taking the questionnaire. Obviously, if you are an investment expert, a pro, we do get quite a lot of investment experts on the platform, and you're happy to manage your own investments, then you can choose from any of the ETFs that we've got on there. We've got 650-ish ETFs on the platform at the moment, and you can build your own portfolio yourself, which is totally commission-free. I think final point that's worth mentioning here before I stop and have a drink of water is that you should only be investing if you don't need the cash for the short term. If you need the cash in, a good rule of thumb is about 5 years. If you need the cash sooner than that, then you'll want to be keeping the cash in a much safer vehicle, like a money market fund, like we've just talked about, because the risk of loss is much, much lower. Right. So that is all I wanted to say on that one. I think the bit that most people on the webinar will be interested in here is why you should be using your company vehicle to invest. I think the basics of investing are really interesting, but as business owners, I think this is something that's a little bit unique, and why you should use your company as a vehicle for investing.
Yeah, and I think this is where you are running a business, running a company, you have options and choices, which is great. We're all, like everything, we want to take money out of our company to pay the mortgage, have nice cars, better holidays, just sort of do life. But also we're taking money out to invest ourselves. So whether that's in ISAs or basically putting into a pension contribution, whether the company's paying for it or making a personal pension contribution, we are encouraged to make those investments because it's tax efficient. But the trouble is, taking money out of the business, it actually costs money. So not only are you having to pay income tax if you're putting a person into an ISA, yes, you've got the benefits of tax relief when the company is paying your pension contributions. It's a case of actually managing that as appropriate. But also, if you're in a situation where you've already maximized your retirement, your pension contributions within the year because you have an allowance, or you've meet your lifetime allowance, it then starts to cost you money. And therefore, you think about, how do I diversify my portfolio? And therefore, with a company, you have options. So therefore, it's a case of, if you've got surplus cash, and I think surplus cash is the key. So putting in my sage hat on, my accountant hat on, it's making sure you understand your finances, you understand your profitability, you understand what your business plans are and your cash needs. It's therefore thinking about what you do with your surplus cash, and therefore it's thinking about what do you do cash in a short term, but also your long term. So therefore, what we've been seeing over the last couple of years is the Chancellor has been seeing how do they actually take more tax revenue. And once upon a time, that mix of a low salary and high dividends was seen as the best way of actually taking cash out of the business. It's still okay. It's not as efficient as it used to be. And this is why it's important to be having a more diverse portfolio in terms of investment needs. So whether that's taking cash out of the business, which costs you more tax, income tax, or actually using the company vehicle, therefore using the cash within the business, invest in the company's cash, and they're getting the return, and therefore obviously paying less tax in the short term, which means when you're thinking about your long-term retirement plans as a business, it's a case of when you're winding out that business, you'll have greater tax relief. So I think the key thing is that the rates of tax on dividends has been increasing. Your personal allowance has been dropping. So therefore, the people are looking for more ways of actually making a better return on their cash, which they have within their business. And I suppose, Andrew, this is what the purpose of this webinar is, the fact that we are seeing people thinking about what options are available, and things like Invest Engine gives those options, doesn't it?
Yeah, that's absolutely right. So I think the general idea is that rather than paying out your profits in the form of dividends to you and being subject to dividend tax, you can keep the cash inside the business and invest any business profits before paying the dividend tax, right? And the dividend tax rates, correct me if I'm wrong, about 33%-ish up to about 39%-ish, something like that.
Yeah, effectively, depending on what other income streams you've got. And suddenly it's becoming quite painful, isn't it? And therefore, why pay tax on taking cash out when, if the cash is left in the company, you're effectively only paying 19-20% on that return within the company. And then when you want to choose to, you can take the cash out at a later date, but certainly getting the return.
But that doesn't mean you pay no tax, right? You have to pay that dividend tax at some point. You have to take the cash out of the business at some point. But I guess the idea is that because most people tend to have lower incomes later in life, then the eventual dividends that you'll have to take out are likely to be taxed at a lower dividend tax rate than you'd pay if you withdrew it today. Is that right?
Correct. That's right. And this is why it's so important when you've got the situation where you've got the company trading profits as well as your own income needs, working with an accountant is key. So not only working with your investment planner in terms of where do you get the best return for cash, but also working with your accountant to have the better understanding in terms of what your tax position is today, i.e. what are my tax liabilities, not only as a company, but also those payments on account which you pay every January and July, but also what that impact is going to be over the next couple of years, because the rate of income tax has been increasing. So if you're thinking you're going to be drawing out more money in terms of dividends, that's going to have a knock-on effect on payments going out, which means if you can actually manage what you need to take out to live, how could you make a better return of that going forward as well?
Yeah. So I think that's a good point. It's worth mentioning that the company still has to pay corporation tax each year, so it doesn't reduce your corporation tax bill. And companies are still going to have to pay tax on the interest income and the capital gains from investing. So
Correct.
The interest income from bond ETFs and the realized gains are potentially liable for corporation tax, but dividend income, correct me if I'm wrong, but dividend income from equity ETFs is exempt from corporation tax. Is that right?
Yes, from that sense, from one company to another company, yes. But I think this also goes hand in hand, the fact that if you're drawing cash out of the business to either invest in an ISA, obviously an ISA is tax-free, you're effectively going to be paying anything between 30 to 39% income tax on that to take it out. So therefore, what return are you getting from it? And if you are then taking that cash to maybe put into stocks and shares personally, again, yes, you've got the risk in terms of the investment. Yes, you may have your capital gains allowance personally, but also what returns are you getting? But also you're having to pay tax to get the cash out. So this is why it's so important to have a really understanding of your mixed portfolio and thinking about what your short and long-term gains are.
Yeah, and it's a good point you mentioned earlier before. This is especially useful now that the dividend tax allowance has fallen to just 500 quid. It used to be a couple of £1,000 a few years ago, and before that I think it was even up to £5,000.
Yes,
So that means that more of your dividends are going to be taxable if you withdraw them from the company now.
And also with the freeze on personal allowance, etc., that's all lower rated, certainly being taxed more as well.
Yeah. And the final point there, we've got a few very fortunate clients who are in the lucky position of having already maxed out their pension allowances for the year, which is currently £60,000. And investing through your business is especially useful if you're in that position, because any contributions into your pension above that annual allowance, they're taxed at your income tax rate. So if you've already maxed out your pension allowance, but you still want to invest tax efficiently, then doing that through a business account is a great way to go. And it's something that quite a few of our, again, very fortunate clients do for that reason. So I think we've hit like most of the key points here. I think the main takeaways so far in terms of investing using your business account are that you can get better rates for short-term cash needs if you invest in money market funds. For longer term goals, the ability to invest in the stock market for higher returns, that's a plus, and the potential tax advantages that come with investing through your company.
And Andrew, I would also argue is the fact that if you are taking money out personally from the company to invest in other areas, that naturally kicks on in terms of your own personal tax return and the calculations around it, which actually become more complicated potentially. And therefore, keeping it simple within the company just gives you further options as well, and also simplicity of the return.
Yeah, no, that makes a lot of sense. Right, so final slide we've got next coming up. Just before we wrap up, we as a business, InvestEngine, have spoken to some of our business account holders recently, and they've obviously mentioned in their feedback all the benefits we've been talking about, all the reasons that you should be using a business account for. But there are also benefits to opening a business account specifically to InvestEngine, which seem to be popular with clients. So I've listed a few of the more common ones on the slide here. I don't want to spend too much on this. I don't want to become too salesy. But I think it is worth going through them because I think this is a kind of why InvestEngine slide. And just to take it from the top, I was chatting to our head of customer service the other day, talking about lead times, how long does it take from the point of application to having the account open, and business accounts on the platform are set up most of the time, the vast majority of the time, in less than 24 hours from the point of application. And goodness me, I've had to do some really painful bank applications. It takes absolutely ages. There's so much back and forth, so much paperwork. So being able to open an account in such a short amount of time, I think, is a big advantage. And there's no ongoing admin either. These banks have lots of KYC and ongoing requirements that you don't have to suffer through if you open an investment account. And on that point as well, the second point there, the free LEI. This is something that clients value quite highly. So this is the point that if you don't already have an LEI, a legal entity identifier, we, InvestEngine, will provide one to you for free for the first year. And then if you fund your account with £20,000 or more, InvestEngine will continue to provide one for you free of charge. Otherwise, if you don't manage to get to that £20,000 level, you'll then have the option to renew the LEI yourself, or InvestEngine can provide one for you for £45 per year. And that point on fees there leads very nicely into the third point, which is fees. Speaking of fees, it's one of the main reasons that clients like us, that clients know us. We have a reputation for being a low-cost provider, which is a really good reputation to have because costs are a really important part of the investing journey. So it is free to open an account. I know that some other providers charge for business accounts. So the fact that it is free on InvestEngine, I think, is another plus. The DIY investing service is totally fee-free, no buying or selling costs, no account charges. All you pay is the costs for the underlying ETFs that you'll have in your portfolio, which we can't do anything about. That's up to the ETF issuer. And then for our fully managed portfolios, which I mentioned earlier, if you want us to manage your portfolio for you, then we charge a fee of 0.25% a year, which is the lowest in the industry. Fourth point, automated investments. This is really the idea that we've just introduced a thing called savings plans, which means that you can add to your portfolio on a weekly, bi-weekly, monthly basis, whatever works for you. You can just invest in a way that kind of suits your business cash flow needs. And then you can also set up automated investing so that when that cash hits your InvestEngine account, all that cash is invested automatically for you in line with your portfolio's target weights. So you can just set your recurring payment, forget about it because you know it'll all be invested automatically. It's very light touch, which is exactly what you want your investments to be like. We mentioned liquidity earlier. and you can withdraw cash from your business account without notice. We don't charge any exit fees, anything like that. So it's all very liquid. The low minimum investment, I think, is a nice one to talk about, because our £100 minimum, we have a minimum of £100 investments, and you can top up from £1. I think that really speaks to the point that smaller businesses can benefit from these business accounts too. It's not just the big businesses. It's not for the huge businesses with massive turnover. Our minimums are really low to enable as many businesses as possible to take advantages of the benefits that we've been talking about for these business accounts. And final point, we are obviously covered by FCA regulation and covered by the Financial Services Compensation Scheme up to the usual £85,000 limit. Now that takes us to the end of the formal presentation. So you actually finished a couple of minutes early, which is unusual and very nice. It means that we have extra time to go through the Q&A. Plenty of time to still ask questions. So if you do have any questions, please stick them in the Q&A box and we will answer them. So let's just have a look and see what we've got. Okay. Okay. Who, kind of a vague question, but that's fine. Who can open an InvestEngine business account? The answer to that is limited companies and partnerships. Those are the two kind of company structures that we're set up to be able to open accounts for. I think if you run another business like a sole trader, then I think it's best to get in contact with us and then we can discuss your options. Chris, this might be one for you. What sort of businesses should consider investing?
Well, that's a good one. I think it comes down to businesses which have a relatively stable cash flow. So you've got an element of certainty. So if you're a business where you have huge fluctuations in terms of trade or whether your income streams are coming through, then it's a case of actually having a really good handle in terms of your finances and business planning. But if you've got a business with regular customers paying you, you've got good cash flow, maybe service industry, etc., where you have pretty good certainty in terms of where maybe your VAT returns and your profitability, you can sort of manage quite happily in terms of, let's say, what surplus cash you've got. Now, I think this comes down to the difference between profitability and cash outflows. You may have a business which is actually quite profitable, but actually if you've got quite a bit of debt, you've got quite a few assets on hire purchase and you've got loans, you need to be thinking about not only your profitability, but your cash which you need to pay off those debts as well. And I think this is why it's not just about the business type, it's actually your business trading situation and also your overall balance sheet. And this goes back to the putting my old accountant's hat on as well as my software hat on, is the fact that are you on top of your business finances? How regularly do you reconcile your bank? How regularly do you review your management information in your financial position with your accountant or bookkeeper? Do you understand in terms of what your debtor days are, how much cash is locked up with your customers? Do you know who your suppliers are? And also how much on a monthly basis are you paying on hire purchase and loans? That way you have a really good idea in terms of actually what is your surplus cash on a monthly basis. And really that is then what you need then to be thinking about how much of that should I actually be putting into some sort of investment portfolio, and also how much I should be paying for saving and putting to one side for my taxes. If you know what your corporation tax liability is going to be, let's call it £40,000, you know that you need to be putting £3,000 aside every month to saving for that, which is then payable 9 months after year end, which then in theory is something which you can get a better return from.
Absolutely. We've had a question here from Matthew about tax reporting. So that's definitely one that I can answer. So at the end of the tax year, InvestEngine will provide you with 2 reports. The first is a consolidated tax certificate, a CTC, which shows the interest income and the dividend income that your portfolio has earned. And the second report is a capital gains tax report, which shows the realized gains and losses on the ETFs in your portfolio. And both those reports are going to be for the 12 months ending the 5th of April. So it's perfect for completing your tax return. And you can also, if you want to, go into your account and generate custom reports and statements. If you go to the reports section of the app, there's a report little section that you can generate whichever reports you want. So yes, there are reports that we provide to you specifically for this purpose. Paul's asking about the liquidity of ETFs. He understands that we need a counterparty to buy. That's absolutely true. Paul, we do we do sell to counterparties when we sell our ETFs. So if you wanted to withdraw cash from your money market fund, we would then go to a counterparty to sell that to. But we do have screens before we add ETFs to the platform to make sure that they are all very liquid, and there won't be settlement delays. So for all intents and purposes, the maximum waiting period for selling a fund in general, and specifically a money market fund, should be 2 days. Occasionally, if you're investing in more illiquid funds in more exotic areas of the market, and emerging markets and small caps, for example, sometimes the settlement can take a little bit longer. But for the biggest funds and the money market funds, definitely settlement should be 2 days. Okay.
Andrew, try to take the question about from an accounting perspective, how should money be invested and categorized in your accounting software, and what happens when it be disposed? So if you imagine, in simple terms, that if you've got £10,000 in your bank account, that is a balance sheet item. If you then actually invest that with, let's say, InvestEngine, for example, that is effectively like another bank account in simple terms. So it's an asset of the business. So you therefore, within your accounting software, I would simplicity actually creating another cash or bank account, because that way it's much easier to account for the transfers in and out. It'll be dealt with as a balance sheet item. And then when it comes from returns, so for example, if you receive dividends or you have a capital gain, there will be movements on that account, and that will be effectively treated as interest or dividends received within the profit loss account. So it's relatively straightforward accounting.
Okay, I've got one here that I think I can probably take. How much cash would a business ideally invest? It's a difficult one to answer, really, because it does kind of depend on the business. But I guess the first thing to point out is that our minimum is £100. So the investment account is meant to be an option for all businesses, no matter the size, as we talked about before. Given the higher returns on offer from money market funds versus banks, I think that's a great way to kind of park your cash reserves, your short-term liquidity needs. And for longer-term investing, I think the best way to think about how much you should be investing is the kind of little and often approach. If you set up an automated schedule for your investments, I think using the savings plans and the automated investing that we were talking about before, investing a little bit every month or every 2 weeks or every week is a really good way to do it, because you end up not having to think about it. And which is exactly what you want from your investments. You want them to be set and forget, so you can leave them to compound away in the background, generating nice returns for you, and then only touch them again when you need the cash. And given that you don't need huge amounts of cash to get started, yeah, I'd say little and often it's probably the way to go for that one. Okay, we've got a question about tax here. We've actually got quite a lot of questions about tax, which I'm hoping you're going to give me a hand with.
Yeah, I'll try to do my best.
Yeah, but there is one about, I think we have mentioned this already, about the dividend, how dividend income is taxed for corporation tax purposes.
Yes, so if you've got dividend income from investments, that is effectively like interest as well. So from a company perspective, you'll be taxed at normal trading rates. If you're on a personal situation, this is where you then have the dividend allowances, which is now £500 in 24-25 as an individual, and then you'll have your various other rates, investment rates, as an individual as well. But from a company perspective, it's the same as the CT rates.
Okay, we've got a question about US citizens here. Are business accounts available for US citizens? I'd have to double check, but I'm pretty certain the answer is no. I don't think we can onboard business accounts if the directors or persons with significant control hold US citizenship. I think from memory that is something we might be investigating in the future, but for the moment, the answer I think is no. The best way to get a definitive answer is to email us. And again, this goes for all other questions that you want answered. Support@investengine.com is the best way to go if you've got specific questions like that.
There's a question here. As a director in the company, can I loan my company a lump sum to invest for the company, meaning the company money comes directly from me in my personal account? Well, the answer is yes, because as a director of a limited company, you can loan money to your business. It's like any bit of investment. It's a liability. It's a liability the company has to you. But in every situation, it's making sure that depending on the shareholders' agreement, are you the sole director, are there other shareholders and directors of the business, you have that documented. There are, like everything, speak to your accountant in terms of your personal situation. But also it's a case of an opportunity, the fact that if the company owes you money as well, you may also be able to charge the company interest on that liability as well. So like everything, it's ability to, there are flexibility in those terms, but again, I would also speak to your accountant just to make sure there aren't any personal circumstances which actually could be against you as well. But in normal terms, there's no reason why you can't loan the company money to invest on your behalf.
We've got a great question here from Martin saying that some savings accounts are about kind of 4%-ish. So asking whether InvestEngine will ever have a similar savings account. And he's saying he sends his VAT and corporation tax money to Tide. He says that the clue is probably in the name InvestEngine, but there's no harm in asking Save Engine. There's an angle. That's one for the marketing team. So in terms of like-for-like savings accounts, I'd say stay tuned. I can't say anything. But I think what we've been talking about in terms of the rates on offer from money market funds is a really attractive alternative to the likes of savings accounts. I know that a lot of savings accounts not only have lower rates than money market funds, so I think, you know, some of the competitors are kind of 4.5-ish%, money market funds 5.2, and they track the base rate a lot more closely. So when rates rise, you'll get the full impact of that rate rise a lot sooner, because what a lot of banks do is that they'll track the reduction in interest rates on the way down, but then when the rates start being hiked again, then because banks have an incentive, a very understandable incentive to pay out as little interest as possible to deposit holders, they won't track the increase in the base rate as much. And we saw that from one of the first charts in the slide deck, which just showed that as rates have increased up to 5.2%, the average business accounts rates have kind of been roughly half of what you can expect to get from a money market fund. So in terms of actual kind of de facto savings accounts, we don't have anything like that at the moment, but a money market fund is a really excellent, liquid, safe, higher returning option. Matthew's asking, will the auto invest feature self-balance? And the answer to that is yes. If you allocate your auto invest, if you turn your auto invest feature on, then it will automatically invest all of your top ups in line with your target weights into your portfolio. So if you've got 50% equity and 50% in bonds, and you have a kind of recurring £100 payment into that portfolio, then £50 will go into your equities, £50 will go into your bonds. And then if it ever ends up getting out of whack, then we have a one-click rebalance option where you can just go into your portfolio, have a look, and let's say equities have done really well and gone up to £60, then you can go in and say, look, one click, bang, it takes you back down to your 50-50 target weight. Okay, I think we've got time for a couple more questions before we wrap up. What cash should businesses actually be investing? I'm hoping we've answered this question already, but just to reiterate, I think in money market funds, you can be investing anything that you'd normally keep in a bank account, so any kind of near-term expenses, liabilities. In an investment portfolio of stocks and bonds, you should only be investing cash that you don't need for the next 5 to 10 years. If you think they need the cash in like 5 to 7 years, then you need to be on the kind of safer end of that stock bond continuum that we saw in the chart with all the kind of variations in returns between the two asset classes. So the kind of the lower down you are on that 5 to 10 year time period, you should be having more in bonds. If you need the cash in kind of 10 years plus, if your goals are quite far into the future, let's say you're retiring or something like that in kind of over 10 years, then you should be in a higher return portfolio with mostly stocks, bearing in mind that over the course of your investment, you will see larger losses. But because you have that nice long time frame, you have that ability to wait and your portfolio will recover and you can generate those higher long-term returns that stocks offer. Right, have we got any final questions that you want to answer, Chris? Otherwise, we will call it there.
I think we're pretty much there, aren't we?
Okay, that's great.
Yes, okay.
if we haven't answered your question today, there are a couple of technical ones in there. That's fine. What we do is we copy and paste all of the questions that we've been asked today, and we will answer them over the coming days. Again, you can always email support at investengine.com if you want any direct questions, or you can post on our community forum, and we can answer any questions using that method as well. So we are now at 5:45, and all that leaves me to say is a big thank you to Chris for his time today. And if you do want to find more about our business accounts, you can go to investengine.com/business, nice easy URL, and you're going to find all the details there. So thank you for joining, and see you next time.